You can now pay less tax in Nigeria. See how. Yes, friend, your incorporated company can now pay less tax in Nigeria legally and ethically. Firstly, by harnessing the over 106 tax incentives in the new Nigerian Tax Act. And secondly, by leveraging our tax expertise. This is the key objective of this video, and we'll show you how. This video is specially crafted to assist your company to pay less tax by utilizing the various friendly and supportive provisions of the new Tax Act. One of these friendly and supportive provisions of the new Tax Act is tax incentives. There are so many tax incentives in the new Nigerian Tax Act, but whilst the tax authorities identified about 51 of them, Taxcorp identified over 106 tax incentives. We urge you to listen to our video on tax incentives and adequately make use of the tax incentives because the Tax Act specifically created them for you. We will only mention them in broad terms here. Part of the comprehensive framework for your company to pay less tax in Nigeria is a clear understanding of how Nigerian tax laws and system function with respect to incorporated companies. Your company needs to understand the basic concept, principles, and practice of incorporated companies with respect to taxation in Nigeria. For instance, what is the exact meaning of an incorporated company with respect to taxation? What are the key features and characteristics of incorporated company? The do's and don'ts in taxation in Nigeria. What are the implications of being an incorporated company? How are incorporated companies taxed in Nigeria? What incomes, profit or gains are exempt? What are taxed and how? What is the statutory format or template for taxing incorporated companies in Nigeria? What are the allowable deductions and what are not allowable deductions? How are losses and capital allowance relieved and for how long? The foregoing are part of the issues which we would deal with in this video. You will get to know the golden rule of tax freedom, the golden rule of taxation of incorporated companies, some tips on tax reduction, and many more. So please, just follow us and be dead attentive to the end of this video. In addition, we will be releasing many videos to educate and enlighten Nigerians and foreigners on the new Nigerian Tax Act and new developments in Nigerian taxation. Consequently, to get the videos hot and fresh, kindly like, subscribe, hit the notification button and share. And should you have any comments, observations, or clarification to make, kindly state so in the comment section. Please be part of it all. What you will learn in this compass, you will learn the following: the golden rule of tax freedom, some tax incentives for incorporated companies, some important definitions and clarifications, fundamental meaning and location of incorporated companies in the cascade of taxation in Nigeria, the golden rule of taxation of incorporated companies, key features and types of incorporated companies, typical names for incorporated companies, chargeable profits, gains, or incomes of incorporated companies, simplified statutory format for computing income tax of an incorporated company, then expanded statutory format for computing the income tax of an incorporated company, meaning and composition of total accessible profit of an incorporated company, loss relief for incorporated companies, capital allowances for incorporated companies, classes, categories, and rates of capital allowance, tax exempt incomes, and final tax incomes, approved income tax rates for incorporated companies, tax deducted at source, withholding tax from incorporated companies, sample computation of the income tax of an incorporated company, some important miscellaneous provisions, some tips on how to reduce the income tax of incorporated companies, some tips on how to better describe your expenses for allowability and for lower taxes, the list of the 22 interdependent compasses, and then about Taxcorp and the authors. Now, the golden rule of tax freedom. Dear friend, do you want to be free from tax wahala? No disturbance of your sleep by a taxman, no knocking at your door by a tax lady, no receipt of long queries by your business from a tax controller, no receipt of unsolicited reminders or threats by your company, no blocking of your bank accounts by the tax chairman, no debiting of your bank account at the directive of a tax authority, no barging into you or your business by law enforcement officers, no forceful entry into your business premises by tax officers and law enforcement officers, no threat of imprisonment by a law court, no selling of your business and or its assets without a court order after the tax has become final and conclusive by the Nigerian Revenue Service. Dear friend, if your answer to the above compound question is a capital yes, then obey the golden rule of tax freedom. And you ask, what is this golden rule of tax freedom? I will tell you that it is called the three C's. And the three C's are comply, comply, and comply. Now, some tax incentives for incorporated companies in the new Nigerian Tax Act. The new Nigerian Tax Act provided a lot of tax incentives for incorporated and unincorporated taxable persons. While the tax authority had identified about 51 tax incentives in the new Tax Act, Taxcorp had identified over 106 tax incentives and counting. For the full list and explanation of the 106 tax incentives, please watch Taxcorp video on tax incentives on Taxcorp channel on YouTube. Here, we will just give you a broad insight. Tax incentives in the NTA include exemption of small companies and small business from paying tax, various tax incentives on exempted incomes or profits, various tax incentives on exempted chargeable gains, various tax incentives on deductions allowed, various tax incentives on loss relief, various tax incentives on capital allowance, tax incentives on final tax incomes, tax incentives on exempted valuable supplies, tax incentives on valuable supplies charged at 0%, input VAT, output VAT set-off relief, VAT refund or VAT credit relief, withholding tax refund or tax credit relief, various tax incentives on exempted stamp duty instruments, relief for double taxation tax incentives. An example is that small companies with annual gross turnover of 50 million naira or below with total fixed assets of 250 million naira or below pay no income tax and pay no development levy. This is very nice, right? And could be nicer because while the signed new tax act says that the threshold of a small company is 50 million naira, the National Assembly says they stand by 100 million naira. Consequently, we wait for the act implementation guidelines from Nigerian Revenue Service. Similarly, small business with annual gross turnover of 100 million naira or below with total fixed assets of less than 250 million naira are exempt from charging, collecting, paying, and remitting VAT. Some important definitions and clarifications which you need to know. Please pay attention here. Typically, an incorporated company is any company incorporated under any law in the world as a legal entity distinct and separate from its owners. Section 202 of NTA 2025 states that a Nigerian company means a company formed, registered, or incorporated under any law in Nigeria, whose central place of management or control is Nigeria, or whose effective place of management and control is Nigeria. Similarly, Section 202 of NTA states that a small company means a company that earns gross turnover of 50 million naira or less per annum and with total fixed assets not exceeding 250 million naira. However, like we stated earlier, it appears that the National Assembly insists on 100 million naira as the threshold. We wait for the implementation guidelines. Section 147 of NTA 2025 states that a small business means a business that earns gross turnover of 100 million naira or less per annum and with total fixed assets less than 250 million naira. Please note that any business providing professional services is not classified as either a small company or a small business. Distinction between year of accounting and year of assessment. Please pay attention here again. Year of accounting. Year of accounting is the accountant's year. Year of assessment is the taxman's year. A year of accounting may not be a full 12 months year, but less. It could be a period. But a year of assessment is always 12 months. Year of accounting is the year in which profit or incomes are produced. Year of assessment is the year in which profit or incomes are taxed. Year of accounting is the year or period for which accounts are prepared by an accountant. Year of assessment is the year in which accounts prepared by an accountant in a year of accounting are taxed by the taxman. Typically, year of accounting comes before year of assessment, and that is why its profits or incomes are taxed on preceding year basis. However, in some aspects, such as employment income and the likes, year of assessment is concurrent and taxes incomes on current year basis. CYB. For the better meaning and location of incorporated companies in the cascade of taxable persons, please pay attention to this graph. There is what we call the cascade of taxable persons in taxation. The chart below shows you how taxable persons are stratified in taxation. Let us locate an incorporated company, also called incorporated taxable person. In the cascade of taxable persons, there are four layers. The topmost, the zenith of the layer is called the taxable persons. Now, taxable persons in taxation are divided into two broad categories, and these categories are incorporated taxable persons, and the other one is unincorporated taxable persons. Incorporated taxable persons, which includes incorporated corporate persons, are divided into two, and they are private incorporated taxable persons and public incorporated taxable person. Private incorporated taxable person are also divided into two: Nigerian incorporated taxable person and a foreign or non-resident incorporated taxable person. While public incorporated taxable person is also divided into Nigerian or resident incorporated taxable person and foreign or non-resident incorporated taxable person. So, for unincorporated taxable person, the first major category, it is divided into two categories as well. The first category or class is made up of employees, and the second class is called self-employed individuals. Again, employees are divided into two classes. There is resident employees and there are non-resident employees. There are self-employed individuals who are resident in Nigeria, and there are self-employed individuals who are non-resident in Nigeria. In taxation, there are two broad categories of taxable persons, and they are incorporated taxable persons and unincorporated taxable persons. An incorporated taxable person in Nigeria is an artificially created person which is created by incorporation under the Companies and Allied Matters Act 2020 as amended by the Corporate Affairs Commission (CAC) for a clearly stated objective as a legal person or entity separate and distinct from its owners and which is liable to taxation in Nigeria. An incorporated company has a life of its own, distinct and separate from its owners, shareholders, or guarantors. Examples of incorporated taxable persons are private companies limited by shares, private companies limited by guarantee, public liability companies (PLC), and corporation sole. An unincorporated taxable person, on the other hand, in Nigeria, is a naturally created person or an artificially created entity which is created by registration under the Companies and Allied Matters Act 2020 as amended by the Corporate Affairs Commission for a clearly stated objective as a legal entity, but please watch this, but which is not separate and distinct from its owners and which is liable to taxation in Nigeria. And what are the examples of unincorporated taxable persons? And they are employees, self-employed individuals, sole traders, businessmen, businesswomen, farmers, sole proprietors, entrepreneurs, freelancers, independent contractors, suppliers, and service providers, business names, partnership and joint ventures, enterprises and small business owners, non-governmental organizations, estate trusts, settlements, and communities. The golden rule of taxation of incorporated companies in Nigeria. Please pay attention to this golden rule, because once you get this golden rule, you have gotten the taxation of incorporated companies in Nigeria. The golden rule of taxation of incorporated companies in Nigeria is that the incomes, gains, or profits of an incorporated company are taxable in Nigeria if the company is deemed to be a Nigerian company in a year of assessment, or where the company is a non-Nigerian company, the incomes, gains, or profits are deemed to be derived from Nigeria for a year of assessment. And where the company is deemed to be a Nigerian company, the income, gains, or profits are deemed to accrue in Nigeria and are chargeable to tax in Nigeria wherever they may arise, and whether or not the income, profits, or gains have been brought into or received in Nigeria. This is the concept of taxation of global income, what some people also call worldwide income. Section 6 of NTA 2025 clearly backs this up. The golden rule of taxation of an incorporated company clarifies what is to be taxed on an incorporated company, nature and type, derivability, and global scope of income. Now, what are the key features and types of incorporated companies? Please, you need to know this so that you can understand the implications. Some key features of incorporated companies in Nigeria are: one, nature and creation. An incorporated company is an artificial person or legal entity created by law. An incorporated company is created by law, not by God or human being. It is created by law. Please note this very importantly. Compliance with law. As a creation of the law, an incorporated company must comply with the law that created it and all other applicable laws. Perpetual existence. An incorporated company is created by law for perpetual existence. Consequently, only the law can terminate its existence and not the death of its owners or members. Separate legal entity. An incorporated company is a legal entity created by law and which is distinct and separate from its owners, shareholders, members, or directors. Limited liability. An incorporated company is a limited liability company, which means that the liability of its owners, shareholders, members, or guarantors to the company and its debts and liabilities are limited to the amount unpaid on their shares or guarantee and does not threaten their personal assets. Separate lives and death. As a legal entity, the lives and death of owners, shareholders, or members of a incorporated company are separate and distinct from that of the um, uh, incorporated company. Consequently, the death of any of its owners, shareholders, members, guarantors, or do not affect the continued existence of incorporated company. The lives, I repeat, the lives of an incorporated company are totally distinct and separate from the lives of its owners, shareholders. They can be sick, they can die. Why? And that will not affect the perpetuity of the incorporated company. Legal personality. As a legal entity with legal personality, an incorporated company can conduct financial and non-financial transactions by itself and in its own name. Legal liability. Similarly, as a legal entity with legal personality, an incorporated company can sue and be sued in its own name and not that of any, some, or all of its owners. Taxation. As a legal entity, an incorporated company is taxed in its own name and not that of any, some, or all of its owners, shareholders, members, guarantors, or directors. Now, here are some typical names for incorporated companies. Tinubu Renewed Hope Industries PLC, Shetima Minerals and Meat PLC, Akpabio Eat Well Now PLC, Abbas Taju Enjoy Yourself Now Please PLC, Our Presidential Mama Nigeria PLC, Nyesom Work and Dominate PLC, Atiku Presidential Oil PLC, Obi New Nigeria Responsible Industries PLC, Dangote Industries PLC, Otedola Investment PLC, Rabiu Bua Manufacturing PLC, Elumelu Energy Industries PLC, Sheyi City Boys Canada Limited, Obi Kobana Entertainment Limited, Osime Talking Man Limited, Burna Boy Worldwide Limited, Davido Global Grammy Limited, Flavor, Bisga Industries Limited, Whiskey, Ojuelegba International Limited, Natasha, Fine Ladies Nigeria Limited, Showore, We Go Die Here Limited, Mama P, We Dey Naija Limited, Oshimole, Work and Jet Limited, Omahi, Work and Enjoy Limited, Ben Kalu, On Your Mandate Limited, Adeboye, Spiritual Limited, Eneche, Pray for Freedom Limited, Jerry Eze, What God Cannot Do Limited, Gumi, Amnesty for Bandits Limited, Iwobi, Manukuva Industries Limited. Now, chargeable profits, gains, or incomes of incorporated companies. Section 4.1 of NTA lists the following profits, gains, or incomes of companies as accrued or derived from and therefore chargeable to tax in Nigeria. Profit or gains from any trade, business, profession, or vocation. Royalties, fees, rents, or interest arising from rights granted for use. Dividends, premium, charges, or annuities, fees, dues, allowances, or any remuneration for service rendered, discount or rebates, disposal of money or money instruments, income, profit, or gains from disposal or lending of securities, prizes, winnings, honoraria, grants, award, laurels, etc. Profit or gains from disposal of property or fixed assets. Profit or gains from transactions in digital or virtual assets. Any other income, profit or gain not falling within the preceding categories. Here is the simplified statutory format for taxation of the income of incorporated as specifically stated in the Tax Act. There are 6 layers, and these 6 layers or line items are total accessible profits, which is profit from all sources, including gains. Then you have second one is loss relief. The third one is remainder of accessible profits. And the fourth one is capital allowance. The fifth line item is total profit. And the sixth one is computed income tax liabilities. So how does this work for the computation of the income tax of an incorporated company? Please pay attention here. The first item is total accessible profit. So when you less loss relief from total accessible profit, you arrive at remainder of accessible profit. And when you less capital allowance, you arrive at total profits. Total profits in companies are also called taxable income, taxable profit, or chargeable profit. It is this total profit that you now hammer your tax rate, which could be 0% or 30%, as the case may be, and you now have completed income tax liability. The sections for you to check are all there from section 27, schedule 1, and section 56 of the Nigerian Tax Act. According to the Act, above table is the statutory format for computing the income tax of an incorporated company. However, the Act stated that exempt incomes and incomes which have suffered tax as source, which we sometimes simply call final tax incomes, should be included in total accessible profits, obviously for disclosure purposes only. And since they are exempt from income tax or from further tax, as the case may be, should be removed from total accessible profits so that they do not suffer further tax. Incidentally, the Tax Act did not expressly provide in the Tax Act how this inclusion or removal of exempt income and final tax income should be done, as it did for taxation of the income of individuals. Please just see the format for taxation of individual where the Act provided everything cleanly. Here there are 4 line items. The first one is total accessible income, just like you have in taxation of incorporated companies. The next one is total deduction, and the third one is total income, and the fourth one is taxable or chargeable income. So how does it work? Once you have your total accessible income, which is income from all sources, you now less your total deduction. Then you have your total income, and you less eligible deductions, and you have taxable or chargeable income. Now, under total deduction, you have 4 items, and they are loss relief, capital allowance, exempt income, final tax income. So you can see that exempt income and final tax were especially mentioned by the Act that this is where you're going to remove them, that you're going to remove them as part of the sum of total deduction. But the Act did not state that in taxation of companies. So that's where some problem arise. It is based on this now that we have to have expanded format. Since the Act did not expressly provide for how exempt incomes and final tax income should be removed in the format for the taxation of the income of incorporated companies, it is assumed, and that is the practice of Nigerian Revenue Service, that total assessable profit was arrived at after adjusting for deductions not allowed, undisclosed income, deductions allowed, exempt income, and final tax incomes. Going by this assumption, therefore, the expanded statutory format for the taxation of the income of incorporated companies is as follows. Here we have the first item, profit before tax as per company's account, and we have number two as disallowable deductions. There are actually 7 line items and they go this way. The first one is probably before tax as per the company's account. So you add back disallowable deductions, which include deductions not allowed, undisclosed or undeclared income. Then you less allowable deductions, which include deductions allowed but which were not deducted. Then you less exempt income. You can see where exempt income comes in now. And you also less final tax income. Then when you less all that, you now come to total accessible profit, which the Act specifically stated. Now from this total accessible profit, you now less loss relief and you now have remainder of accessible profit. And you go further and less capital allowance, you now have total profits, which, like we said before, is also called taxable or chargeable profits in taxation of companies. Then it is on this total profit or taxable profit or chargeable profit that you apply the tax rate, the applicable tax rate, which is either 0% or 30%, and you have your computed income tax liability. And from this computed tax liability, you now less tax deducted as source withholding tax, and you now have net income tax, net computed income tax liability. Then to this net computed income tax liability, you now add development levy of 4%, which is 4% of accessible profit. Then when you add it to, you now have total tax liability payable. Meaning and composition of total accessible profits of an incorporated company. Section 27 of NTA specifically stated that the total accessible profit of an incorporated company shall be the total accessible profit from all sources, including chargeable gains. Section 41 of NTA details the composition of total accessible profits and chargeable gains of an incorporated company. See list of chargeable profits or gains in their section of chargeable gains, incomes, gains of an incorporated company. The list includes earned income, what some tax scholars call active incomes, and they include profit or gains from trade, business, profession, or vocation. Other earned incomes, such as fees, dues, allowances, or any remuneration earned for services rendered. Income earned from past investments or rights for use, exploitation, occupation of property, and includes royalties, fees, rent, or interest, and other incomes, profit or gains not specifically stated within the preceding categories as specifically stated in section 41 of NTA. Loss relief for loss incurred by an incorporated company. Please endeavor to fully relieve loss. It has so much incentives as we will see now. You have to know and understand the golden rule of loss relief. The golden rule of loss relief is that loss in taxation is first the excess of costs and expenses over gross turnover or income, wholly and exclusively incurred in the production of gross turnover or income in a basis period. And second, which the Tax Act allows to be relieved from the amount of the assessable profit or income of the year of assessment after that in which the loss was incurred, and in subsequent years of assessment until the loss is fully recouped. The loss to be deducted in arriving at the total income of an individual is The amount of loss incurred by the individual during the year preceding a year of assessment in a trade, business, vocation, or process. And when, please, one correction here. When we're talking of individual here, we're talking of incorporated company. So let's read it this way. The loss to be deducted in arriving at the total income of an incorporated company is the amount of loss incurred by the incorporated company during the year or preceding year of assessment in a trade, business, profession, or vocation, and the amount of loss incurred on the disposable of a chargeable asset. So please, there are two sets of losses. The loss incurred in your business is relievable, and the loss incurred in disposal of chargeable asset is also relievable in computing your income tax. However, please note this: in no circumstance shall the aggregate loss deductions from income exceed the amount of that loss. It cannot deduct more than the loss you make. That's why you have to be careful, because if you are deducting it every year, let's say for the next 2, 3, 4 years, you should make sure that the aggregate from the first deduction should never exceed the total deduction loss that you incurred at the beginning. The loss shall be deducted as far as possible from assessable profit of a trade, business, professional, or vocational, or the first year of assessment. After that, in which the loss was incurred, and in subsequent years until loss is fully recouped. Fantastic. This is a great tax incentive. There's no more limit. The loss incurred during any year of assessment shall be computed in accordance with the basis period general rule. Any loss incurred in any period from sales, disposal, or any other transaction in digital or virtual assets shall only be deductible against the profit or gain from digital or visual assets. Please watch and listen very attentively on how you can reduce tax through innovative application of the golden rule of loss on our YouTube channel. Taxcorp, very, very important place. Capital allowances for an incorporated company. Again, you have to know and understand the golden rule of granting capital allowance. The golden rule of granting capital allowance is that capital allowance is the allowance which the tax law grants a person for the use of a qualifying asset or qualifying capital expenditure in a trade business, which is granted as a statutory percentage of the cost of the asset and deducted from the remainder or the assessable profit or income in determining the profit or income of the trade business in a basis period for a year of assessment until it is fully recouped. Fantastic. This is another great tax incentive. Capital allowance has no limit any longer. You can deduct it fully in 1 year, or you can carry it forward and deduct it to eternity. Fantastic. Please watch how you can reduce tax through innovative application or the golden rule of granting capital allowance on our YouTube channel, Taxcorp. Here you have the classes, categories, and rates of capital allowance. The Act in computing capital allowance for computing capital allowance has divided qualifying capital expenditure into three. It has put them into three classes: class 1, class 2, class 3. Class 1, the annual rate of capital allowance for class 1 is 10%. The annual rate for all the expenditures in class 2 is 20%. The annual rate for all the expenditures in class 3 is 25%. Now, class 1 has 5 expenditures, which include building expenditure, agricultural expenditure, mast expenditure, intangible assets expenditure, heavy transportation expenditure. And class 2 has plant expenditure, 5 of them: plant expenditure, agricultural equipment expenditure, furniture and fittings expenditure, mining expenditure, other equipment expenditure. And the class 3 has 3 expenditures: motor vehicle expenditure, software expenditure, and other capital expenditure. Please, I hope you remember that we said that there is no more initial or annual allowance. What you have now is just one allowance called allowance in the Act. Tax exempt incomes and final tax incomes. Tax exempt incomes. Incomes of a company that are exempt from tax include income earned from bonds issued by a state or the federal government of Nigeria, Dividend received from investment in wholly export-oriented businesses are exempt. Dividend, interest, rent, or royalty derived from outside Nigeria and brought into Nigeria through approved channels. Fantastic guy. So once you do that through proper channel, your income is exempt. Final tax incomes. Income for a company on which the tax deducted as source under Section 51 of Nigerian Tax Administration Act is the final tax include. Here are those incomes for which they deduct tax at source and it will be regarded as final tax. The first one is dividend received from a Nigerian company, which you normally call franked investment income, is not subject to further tax. Interest on short-term securities, interest on corporate bonds, they do not suffer further tax, either at 30% or at 25%, as the case may be. You have to know and understand the golden rule of taxability of withholding tax. The golden rule of taxability of withholding tax is that only transactions which have the express nature, constructed or construed in the nature of contract or supply are eligible to withholding tax, except where the Tax Act provides otherwise. Consequently, transactions undertaken in the normal or ordinary course of business are not eligible for withholding tax. Please watch how you can reduce tax through the application of the golden rule of withholding tax on our YouTube channel. You need to know the golden rule of withholding tax so that you know what are subject to withholding tax and what are not subject to withholding tax. Approved income tax rates for incorporated companies. Basically, there are two income tax rates for incorporated company. The first is for small company, it is 0%. This is another tax incentive for incorporated companies. If you're a small company, you will be taxed at 0%. Isn't that good? Then if you are not a small company, your profit, please remember we're talking of your total profit, your taxable profit, your chargeable profit will be taxed at 30%, not your turnover. Section 202 of NTA 25 states that a small company means a company that earns gross turnover of 50 million naira or less per annum and with total fixed assets not exceeding 250 million naira. However, we have to wait for the Tax Act implementation guidelines from Nigerian Revenue Service because the National Assembly of Nigeria is insisting that the threshold is 100 million. So we have to wait for them to give us the guideline. Section 147 of NTA 2025 also says that a small business means a business that earns gross turnover of 100 million or less per annum and with total fixed assets less than 250 million. Tax deducted at source, what you call withholding tax. Tax deducted at source is treated either as a final tax or advance tax. If a tax is treated as a final tax, then the income, payment, or item is not subject to further tax, and the tax deducted at source is regarded as final tax. However, if the tax deducted at source is treated as an advance tax, then the income, payment, or item will be grossed up and subject to further tax. And when the further tax is calculated, the advance tax is deducted from them. Incomes, payments, items which tax has been deducted as source and are treated as advance tax and which will be deducted from further tax include contracts and suppliers, professional fees, interest, commissions, and brokerages, rent, rental, and hire income, royalties, sample of computation of income tax of an incorporated company for a year of assessment. So, just like we showed you the other time, given the what happened with the tax provisions, we have 7 items on how to calculate the income tax of an incorporated company. And we start with profit before tax as per the company's account. Then we now add back disallowable deductions, which include deductions not allowed as per section 21. Then we now add undisclosed or undeclared income as per section 4. Then we now less allowable deductions as per section 20 that were not deducted, and we now remove exempt income, almighty exempt income, and also remove final tax income. And we arrive at the almighty total assessable profits. Then from total assessable profit, we now less loss relief, and we now arrive at remainder of assessable profit. And when we remove capital allowance, we now come down to total profit, which we said in for companies, it is also called taxable profit or chargeable profit, because it is on this particular item that you now hammer the tax rate, the applicable tax rates, to get your income tax liability. And from this income tax liability, you now deduct tax that have been deducted as source. That's withholding tax. Then you now get net computed income tax liability. And when you now calculate your development levy, which is 4% of assessed profit, when you add the two of them, you have your total tax liability. Isn't that easy? Very easy, my brothers and sisters. But please note these important miscellaneous provisions. Basis of computing assessable profit for a trade or business. The general rule for computing the profits of any trade, business, profession, or vocation for each year of assessment is the profit of the accounting period immediately preceding the year of assessment. This is called the preceding year basis, or PYB. There are, however, exceptions to the general rule, as we shall see as we go on. Section 22 of NTA 2025 puts it this way: except as provided in this section, the profits of any trade, business, profession, or vocation for each year of assessment called the assessable profit shall be the profits of the accounting period immediately preceding the year of assessment from all sources. PYB is the general rule. However, there are three exceptions to the general rule which occur in the following three circumstances, and they are: a new business. When you start a new business, general rule will not apply. When you change your accounting date, the general rule will not apply. And when you cease business, the general rule will not apply. They have their own special rules as per the Act. Presumptive taxation, properly called best of judgment. Please don't make it difficult for you, your company, or the tax authority to assess you or your company to tax. For if you do, the tax authority will have no option than to assess and tax you on presumptive tax regime. Section 29 of NTA puts it this way: notwithstanding any provisions of Chapter 2 of this Act, where for all practical purposes, the income of a person chargeable to tax under this Act cannot be ascertained, or records are not kept in such a manner as to enable proper assessment of income, then such person shall be assessed on such terms and conditions as may be prescribed by the minister on the advice of the Joint Revenue Board in a regulation under a presumptive tax regime. Effective tax rate, section 57. Incorporated companies with an annual turnover of 20 billion and above are, and a company which is a constituent entity of a multinational group, are to ensure that the effective tax rate is not less than 15%. Why? Section 57 of NTA 2025 states that notwithstanding any provision of this Act or any other enactment where in any year of assessment the effective tax rate of a company is less than 15%, such company shall recompute and pay an additional tax that makes its effective tax rate equal to 15%. The provisions of this section shall apply to a company that is a constituent entity of a multinational group and any other company with an aggregate turnover of 20 billion naira and above in the relevant year of assessment. The Tax Act defines an effective tax rate as an effective tax rate means the rate produced by dividing the aggregate covered tax paid by a company for a year of assessment by the profits of the company. I take that again. The Act says that an effective tax rate means the rate produced by dividing the aggregate covered tax paid by a company for a year of assessment by the profits of the company. Tax incentives. There are so many tax incentives for incorporated companies in the new Nigerian Tax Act. While the tax authority stated they've identified 51 of such tax incentives, Taxcorp identified over 106 tax incentives. These are contained in our video on tax incentives. Please go and harness them and legally and ethically reduce your corporate tax. Offenses and penalties. Similarly, please go to our YouTube on tax offenses and penalties and know the tax offenses and penalties your company is liable to if you don't do well. It's very important to watch the video. Some tips on how to reduce income tax of incorporated persons. Here are some tips we'll give you. Please pay attention here. Know your tax law very well, particularly as they relate to companies. Just don't rely only on your tax consultant or tax corp. You also have your own duty to do. Secondly, be proactive. Plan your tax matters ahead. Plan all year round, not just at the time of tax. Clearly understand the main characteristics and implications of incorporated companies. Understand deductions allowed and plan to increase them legally. Understand deductions not allowed and plan to decrease them legally. Be creative and innovative, but please don't be fraudulent. Corporatize your business, monetize your personal efforts in the business. Don't mix other expenses with business expenses, including your banking. Don't mix your personal banking account with your business account. It is very dangerous. Describe your business expenses sufficiently and clearly as indicated below. Document all business transactions. You require them later. Keep comprehensive, proper, and accurate records of your transactions. Deduct all taxes and pay all taxes and duties on assets and expenses. Recoup all taxes, be they withholding tax, VAT, and others. Claim all expenses timely and sufficiently. Take calculated risk, and when losses arise, fully claim them from profits. Spend more money on capital assets and fully claim capital allowances. Select and rationalize your portfolio very well. Then invest more on tax exempt investments. Look out and choose investment with which withholding tax is a final tax. They are tax low. Final tax is a good man. Like them. Harness the tax incentives to reduce your tax. Go to our YouTube channel, Taxcorp, and harness the over 106 tax incentives which we have identified for you. Significantly increase your company's contributions to National Health Housing Fund. They reduce your tax liability and increase your capital assets, increasing the morale of your staff. Significantly increase your contribution to National Health Insurance Scheme. They reduce your tax liability and enhance the health of your staff. Significantly increase your contributions to pension fund. They reduce your tax liability and guarantee a better life for your staff when they retire. Most importantly, consult and stay with Taxcorp for all your tax matters. Now, some tips on how to better describe your expenses for allowable deductibility. Please be business focused, not personal. Be creative. Favor allowed deductions as against non-allowed deductions. Be exact and apt. Standardize your descriptions. Describe sufficiently. Be consistent. Don't trade details for brief. Avoid ambiguity. Avoid vagueness. Be very clear. Avoid personal, private, or domestic description. Here you have between two interdependent compasses. So that includes the tax subjects. Just go through them, and anyone you desire, you go and watch our video on them. And if there are other ones that you want us to intervene, please drop your suggestions or your requests on the comment section or contact us through our other contact channels, and we deal with that accordingly. Here is about Taxcorp and the principal consultant. Taxcorp is a Nigerian tax consultancy firm which specializes in tax matters. Prince Chidi, FCA, FCTA, MBA, is a principal consultant. Prince Chidi is a licensed fellow of the Institute of Chartered Accountants of Nigeria, ICAN, and the Chartered Institute of Taxation of Nigeria, CITN. Taxcorp and Prestige have provided tax services to numerous individuals and corporate bodies in both the public and private sectors, locally and internationally, since 1990, over 3 decades. The beneficiaries include the Nigerian Revenue Service, formerly Federal Inland Revenue Service, Revenue Mobilization Allocation and Fiscal Commission, (RAMFAC), so many state internal revenue services that include Lagos State, that include other states, that include Kano and other states, then the Federal Capital Territory Internal Revenue Service, and many private companies and individuals. Distinguished ladies and gentlemen, please, here you have our contact channel, our contact details, and should you desire anything, is anything bothering you, please contact us through any of our contact channels. Thank you so much and have a nice day.